I have an awesome video for you guys today. Now, if you watch the mainstream financial networks or read the standard economic playbook, you're taught to look at the fixed income market through a single isolated lens. You're told that interest rates and bond yields move up or down based entirely on the actions of the Federal Reserve. And the common narrative is that central bankers, they sit in a room, they adjust a short-term policy dial, and the global price of money seamlessly moves according to their commands. Well, that's a superficial explanation, and it completely ignores the actual plumbing of global capital markets. Central banks can influence short-term policy rates, of course, but they do not control the supply and demand dynamics that set the long-term borrowing costs. The true price of money is determined by a relentless, non-stop competition for a finite pool of global liquidity. And for decades, this competition has been entirely one-sided. The United States Treasury has operated as an absolute monopoly, and they've sat at the top of the global financial architecture in the fixed income market. And because US government debt was backed by, the taxation power of the United States government, the world's largest economy and global reserve currency, it was priced as the ultimate risk-free asset. If an institution needed to allocate billions of dollars into a safe, liquid instrument, you know what they did? They bought a treasury bond. And I want to tell you that today, that monopoly is officially dead. And while the public is completely distracted by an equity market volatility and a quiet historic war has really broken out in the fixed income market. The US as a sovereign state is no longer competing against its own historical metrics. It's actively fighting a war of survival against private corporate balance sheets. And today we're going to go underneath the surface of the bond market to look at the mechanics of this capital war, the shift in credit quality, and how this quiet collision is actually squeezing out middle corporate America. To understand why this capital war has broken out, you have to look at the unprecedented transformation that's occurring on the supply side of the fixed income market right now. The architecture of the financial system relies on the assumption that the government issues a controlled and predictable amount of debt in order to manage its baseline fiscal operations. And that assumption has been completely destroyed by what's actually happening in reality. The United States government is currently running multi-trillion-dollar annual deficits, and this has been during an era of relative peace and economic expansion. And in order to fund this massive fiscal shortfall, the US Treasury must continuously access capital markets. And they do so by auctioning off trillions of dollars in new bills, notes, and bonds every single year. Now, the sheer velocity of this debt issuance has triggered a massive supply shock inside the financial plumbing. The state is forcing an ever-expanding volume of paper into the global system, and this is requiring a massive and continuous influx of buyers just to clear its weekly auctions. Now, in past decades, foreign central banks, domestic commercial banks, they've absorbed this supply really without any hesitation. But today, the institutional buyer base has been showing severe signs of fatigue. At the exact same moment that the government's demand for capital is accelerating on an exponential basis, the credit quality of the state is actively deteriorating. The country is now spending close to $1 trillion annually just to service the net interest on its already existing national debt. And if we look at this from a pure ledger perspective, the US is borrowing new money simply to pay the interest on its old liabilities. What does that sound like? Well, this is the classic debt trap. And the major global asset allocators are looking at this math and they're recognizing that the risk profile of the ultimate risk-free asset has fundamentally shifted. While the United States balance sheet is deteriorating under the weight of fiscal expansion, the private sector has weaponized its own large scale to present an entirely different opportunity to the global market. Over the last decade, the massive consolidation of corporate power has created a select tier of mega-cap tech names and industrial conglomerates that possess unprecedented financial capabilities. These corporations, they're no longer standard businesses. They do not operate at the mercy of localized economic cycles. Instead, they've transformed into self-funding global infrastructure platforms. Think of companies like Apple, Microsoft, Alphabet. These companies carry fortress balance sheets, and these balance sheets are backed by hundreds of billions of dollars in pure cash reserves and continuous non-cyclical cash flow generation. These companies, they hold more highly liquid assets than really many sovereign central banks do. And when these mega cap giants, when they decide to tap debt markets, they're not doing so out of financial desperation or structural weakness. No, they're doing so strategically. They want to fund multi-decade capital expenditures. And what's the capital expenditure right now? Well, think of the global artificial intelligence infrastructure build-out, data centers, advanced automation. And because these baseline business models generate massive cash surpluses, they do not need to access the debt markets to survive. They access them to maximize the velocity of their corporate expansions. And this is creating a major inversion inside the fixed income market. For an institutional asset allocator, such as a multi-billion-dollar pension fund, an insurance giant, or a sovereign wealth fund, the primary directive is the absolute preservation of capital. When these institutions look out across the landscape to deploy their funds, they are forced to compare a sovereign state like the US running a compounding fiscal deficit against a mega cap corporation holding a pristine cash surplus. And as of right now, the corporate debt represents a cleaner, more secure credit profile than the United States does. And this is destroying the government's historical monopoly on safe capital. This brings us to the actual friction point, where these two giant supply curves are colliding, and this collision is in the global pool of liquidity. Most commentators discuss capital as if it is completely infinite, believing that the financial system can print endless credit to satisfy all borrowers simultaneously. But the physical reality of the fixed income market is that investable capital is finite. Institutional portfolios operate under rigid asset allocation mandates. A pension fund cannot hold more than a specific percentage of its total assets in fixed income instruments. And this means that they have a fixed, predetermined bucket of dollars that they can then spend on bonds each quarter. And when the US Treasury is dropping trillions of dollars in new debt supply into the market at the exact same time that cash-rich corporations are issuing hundreds of billions in premium investment-grade bonds, a collision occurs. It was bound to happen. And this is the reality of the crowding out effect. Because the total volume of bonds entering the system is expanding faster than the natural buyer base, sovereign states like the US and the private sector, they're forced to actively bid against each other to capture the same institutional dollars. This competition completely changes the pricing mechanism of the yield curve. To convince an institutional manager to buy a sovereign treasury note instead of a premium corporate bond, the US Treasury can no longer rely on prestige or narrative. It is forced to clear the market by offering structurally higher yields at its weekly auctions. The government must pay a premium in order to attract capital away from the private sector. And this upward pressure on treasury yields forces the baseline cost of capital for the entire global economy to stay elevated, and it acts as a permanent floor that keeps interest rates higher for longer. The true damage of this capital war is not felt by the federal government or the mega cap tech giants. Both of those entities are insulated by their immense scale. The real casualties of this structural collision are found inside middle corporate America. This is made up of the thousands of mid-cap and standard large-cap enterprises that form the actual bedrock of the domestic economy. And unlike the mega-cap tech monopolies, standard mid-sized corporations, they do not possess hundreds of billions of dollars in cash reserves. They do not have global pricing power. Instead, these companies are heavily dependent on commercial credit, regional banks, and the public corporate bond market in order to fund their day-to-day operations, their inventory cycles, and their capital reinvestments. And right now, these mid-tier companies are slamming face first into a devastating debt maturity wall. Trillions of dollars in legacy corporate liabilities that were issued during the near zero interest rate environment of the early 2020s are actively maturing. These businesses are now being forced to roll over those legacy low-cost debts into today's elevated macro environment. But when they enter the credit market to refinance, they find that the landscape has been entirely picked clean. The finite pool of institutional capital has already been absorbed by the record-shattering supply of US Treasuries and the elite investment-grade corporate bonds. To capture any remaining institutional bids, a mid-tier industrial or consumer-focused company cannot just offer a standard yield. They are forced to provide an immense risk premium. Their all-in borrowing costs skyrocket into the 7 to 9% range. This massive interest rate penalty directly eats away at their operational profit margins, and it forces an immediate contraction in their capital expenditures, halts corporate hiring, and places a major strain on their long-term solvency as a company. Now let's tie this all together. The price of money is no longer a passive metric managed by central bank policy. It has been transformed into a highly competitive battleground. The United States Treasury has officially lost its historical monopoly as the ultimate safe haven asset allocator, and it's now being forced to wage a constant capital war against the fortress balance sheets of mega cap corporate giants in order to fund an ever-expanding fiscal deficit. And this capital competition means that the global yield curve is being held structurally higher just by the pure velocity of supply. And this is creating a deeply fragmented macro environment. Now, for wealthy individual savers and cash-rich corporations, this arrangement is an extraordinary mechanism in order to harvest high and safe yields without having to take on extended equity risk. But for the broader domestic economy, it is a hidden and compounding tax. It keeps consumer credit, mortgages, and auto loans expensive while starving mid-market businesses of affordable capital. That is all that I have for you guys today. I think this concept of government versus corporation debt issuance is incredibly interesting. So I hope you guys enjoyed this video. Please subscribe to the channel and let me know your thoughts in the comments below. Also, feel free to check out my Substack, which is linked in the description below, as well as in my channel bio. Thank you all again. I'll see you guys in the next video. Have a good one.